Hi, good morning. Okay, so today we're going to talk about bonds. There's been a lot of inquiries and a lot of viewer questions as to what are bonds, what's a coupon, how do they pay, how long they're for, who issues them. It's quite a long subject, so what I'm going to do is I'm going to try and incorporate everything I can within bonds and hopefully give you an educational slot that will enhance your knowledge and make you feel a little bit more empowered when it comes to trading and understanding all of the financials and the economics in global markets, to understand that when you're impacting on the trading, there's a movement in one particular asset class, how that will impact and what effect will have on your particular position and impact on where your trading is going to go. Now, one of the backbones or one of the fundamental pillars or the backbone or fundamental pillars of financial markets is bonds. So let's look at what is a bond. A bond effectively is a loan. It's a loan for a set period of time at a set interest rate. Now, who issues bonds? It's a loan to a government, it's a loan to a company. I mean, let's take, for example, let's just strip it down to the very low level. Let's talk about Joe Public. Let's talk about Jeff Bloggs in the street. So Jeff Bloggs in the street typically wants to borrow some money. He wants to develop his house or buy a car or invest in his business or do whatever he wants to do with that money. So what he normally does is he goes to the bank and he borrows money, and that is a straightforward loan, and the bank will give him a loan for 5,000, 10,000, 20,000 over a set period of time at a set interest rate, and he will pay the bank every month interest on that particular loan until the loan is finished. Now, if you take a large company, whether it's Apple, Microsoft, Mitsubishi Metal, BP, that's British Petroleum, Shell, Boots, Target, Intel, any particular company in the world, any particular business in the world, they're constantly in need of money. So what do is they go to the bank to borrow money. Okay, we're not talking government level at this stage, we're talking just company level. So we're going to focus on the business level, what the business does in order to fund itself. So it goes to the bank. Now the bank could be, I mean, it's not going to be a high street bank on the corner, but it's going to be one of the big corporates. So they will go to their banking advisors, whether JP Morgan, Bank of America, Goldman Sachs, Barclays Bank, Daiwa, Nomura, Morgan Stanley, to name but a few. Those are Chase. Those are big names. NatWest, RBS, Lloyd's, some of the capital markets, the big players in financial markets, and they'll go to one of these banks and they say, listen, we need to borrow $50 million or $100 million or $200 million. And what we're willing to do, this could be any company, including Apple and Microsoft, what we're willing to do is we're willing to pay interest on that loan. So along comes Goldman Sachs, let's say Goldman Sachs, for example, or JP Morgan, and they say, no problem, we'll arrange your $100 million. Okay, so Goldman Sachs, we're now going to arrange $100 million to, let's say, Apple, okay, or Microsoft or Intel or British Petroleum or whoever it is, okay. Now what they come along and they say, right, we'll organize that, not lend you, we'll organize $100 million. What does that mean, organize $100 million? They themselves, Goldman Sachs, don't want to take on the risk. So they say, you know what, we don't want to take on this risk because $100 million is big money and the company may fail. For example, if you know Sky News, okay? So Sky News, Sky was considered junk status back in 1994. Rupert Murdoch was considered junk status. So they issued a bond under junk status. We'll discuss this in a bit more detail. Back in 1994, because the company was not good value, therefore the interest rate was higher. Subsequently, Sky has become, Rupert Murdoch's company has become now a AAA company, and it can get rates at a cheaper level. Going back to our example before, and I'm using Apple as an example. So Apple then go to Goldman Sachs, they want $100 million. So Goldman Sachs then say, you know what, we'll arrange it for you. They now become what you call the lead underwriter. So that Goldman Sachs will take on the responsibility to give $100 million, lend $100 million to Apple at, let's say, 3% interest rate, 4% interest rate. The stronger the company, the lower the interest rate, because they've got good credit. So the higher credibility the company has, the lower the interest rate. The lower credibility or the company has, then the higher interest rate. So if a company has AAA rating, their interest that they will pay on that particular loan will be low. And if a company has BBB or CCC or C+, then the interest rate they pay on that loan will be higher because they are higher risk to the bank. So Goldman Sachs now say to Apple, yeah, we're going to give you $100 million or lend you $100 million. And Goldman Sachs will then go to the other banks and they say, listen, we've got this deal for $100 million, but we don't want to take on that risk. Would you also participate in lending the $100 million? And the banks say, yeah, why not? It's a good risk, Apple. So you get JP Morgan, Morgan Stanley, Bank of America, Chase, Wells Fargo, Barclays Bank, RBS, Daiwa, Nomura, Deutsche Bank, all of them come in and say, yeah, we'll take part of that loan. So they will then give to Goldman Sachs or confirm that they will take part of that loan and that they will then lend the money and earn 3%. And subsequently, the banks will then sell it on to the lower level till eventually the man in the street will have part of that loan, which is a certificate of interest, a loan that they've effectively invested $10,000 in an Apple bond that matures in 10 years' time. So Apple will come along and say, we want it for 10 years, we're willing to pay 3% a year, and we need 100 million. Say, no problem. So that scales down, that ripples down to the man in the street. So the man in the street then ends up investing $10,000, $100,000 in Apple, and he gets 3% every year for 10 years on his money. And that is considered a investment. It's considered a good deal, or maybe not a good deal, depends on the individual who's investing at that particular moment in time. Now, if we replace Apple now and we call Apple the US government, okay? So now the US government, in order to finance itself, in order to finance its roads and finance its railways and its infrastructure and everything about the government offices, it needs money. And part of that money comes through from tax revenue, the IRS, but it's not enough to fund the whole business. The business is the United States of America. Now, a bond in the United States of America is called a US Treasury. It can have 2 years, 10 years, and 30 years, okay, even 20 years. So the US Treasury is a AAA loan. Why? Because the US is not going to go bust. So when the US government or the Fed wants to raise money, what does it do? It issues a bond called a US Treasury note. And they say this bond is for 10 years, okay? And for 10 years, we're going to pay you give us $100,000 per section, per bond, per note, and you will get 3%, okay? Great. So along come investors, and they want to be absolutely secure on their money, and they want to be secure on the interest rate. So what do? They say, no problem. They go and buy a US Treasury note for $100,000. That $100,000 is then transferred to the US government, and the US government then takes the $100,000 and spends it. Come 10 years down the line, you want your $100,000 back. So you take your $100,000 note and you redeem it. So they give you $100,000 back. But all through that period of time, the 10 years, you've had 3%, okay? Now, throughout the 10-year period, there is a possibility or likelihood that that bond moves up and down in price. So as it moves up in price, okay, say for example it's gone 100 gives you 3%, then if it moves up above 100, that 3% as a relationship as relative to the 100 becomes a lower percentage, okay? So instead of getting 3%, you might get 2.9% because the bond's costing you now 101,000. So if the bond price moves up to 102,000, you might get 2.88%. It's still 3%, but it's 3% relative to 100,000. Remember, as the price moves up, that percentage becomes lower. For example, what's 10% of 100 is 10 pounds, correct? 10% of 100 pounds is 10 pounds. So if you're getting 10% return on 100 pounds, and you're getting 10%, 10 pounds every month, and that 100 pounds now is worth 200 pounds, 10%, you're getting 10 pounds a month. So that 10 pounds a month on 200 pounds equals 5%, okay? Hopefully I made that clear. It sounds a little bit complicated, I'm trying to keep it as clear as possible. So the US government then goes and issues a bond for $100,000 and you get 3%. Now, people who investors that invest in bonds on a 10-year, you get a higher return than on a 2-year. The reason why you get a higher return on a 10-year than you get on a 2-year, because you are taking the risk of being 10 years involved in that investment, and therefore to attract you, to pull you in, to get that, to invest money, they'll say, if you're in with us for 10 years, we'll give you a slightly higher interest rate than on the 2-year, which is only 2 years you're in, and you can redeem your money in 2 years. So you're going to commit $100,000 for 10 years. You want to make sure you're going to get a pretty good return on that money. What's happened recently is that the return on the 2-year is higher than the return on the 10-year. So what does that mean, and why does it come about? That normally comes about when investors are worried about the long-term future of the economy. When they're worried about the long-term future of the economy, they will buy bonds, therefore pushing down the yield. And when they push down the yield, which is the rate of return, it means they're willing to invest money in a secure asset like a US Treasury bond, US Treasury note. They're willing to invest money there, lose or get a low return, but they know their money is safe. The money is so safe in the US Treasuries, there's people that will take it out of banks and put it into a US Treasury because the US Treasury is safer than the bank. So they're willing to forego a lower interest rate or higher interest rate just to get their money safe in a US Treasury. So if the investors are buying 10-year bonds or 10-year Treasury notes in the US, and therefore the yield is going down and the price is going up, so they're willing to buy it at a higher price and willing to receive a lower yield, it means they're concerned about the economy. Where the 2-year Treasury is higher than the yield is higher than the 10-year, that means that the bond market is trying to attract investors to come in to buy the 2-year, but investors don't want the 2-year. What they want is the longer term security, and that is a lead indicator to a recession. Why is it a lead indicator to a recession? Since World War II, anytime there's inverted whereby the 2-year yield is higher than the 10-year yield, that indicates that the long-term view of the economy is one of going into recession or depression. Investors are buying the long-term notes as a protection mechanism and selling the 2-year notes because it's too short-term. How can I explain that in the simple terms? You've got a choice of a 2-year fixed mortgage, a 5-year fixed mortgage, or a 10-year fixed mortgage. If you think rates are going to go up on your mortgage in the next 2 years, why would you take out a 2-year when after 2 years the rates are going to jump significantly? So you say, you know what, I want to secure my money, I want to secure my expenses. So you take out a 5-year, hopefully to ride out the storm. And if you're really concerned, you'll take out a 10-year fixed mortgage in order to ride out the storm, in order to have that security that your costs are fixed every month. Similar to that, an investor will buy a long-term bond to secure their money. I don't care, I'm going to invest in long-term, I want to get my guaranteed return, I don't want any risks. So their view on the economy is negative, and when analysts, investments and bankers start buying into the long-term bond more than the short-term bond, that is a recession indicator. That's great at a AAA company. What happens if we're dealing with junk status? So some of these companies that are just not worth the paper they're written on, or they have a higher risk of going bust. What they do is they issue a bond also for $100,000, but the interest rate they'll be offering is 7, 8, 9, 10%. It's called junk status. Like junk, you just throw it out, it's worthless. The risk on it is so high that the banks are offering you, or the companies are offering you, a much higher interest rate as a compensation for risk, and therefore invest your money with us will give you a higher return on your money. Most companies that offer junk status bonds are high risk and are likely to go bust. One of them that didn't, which I mentioned earlier on, was Rupert Murdoch's company. They issued in 1994, as I said earlier on, a bond under junk. They were junk status. Sky was junk status, okay? And they issued bonds at 13%, 14%, 15%, 18%, and investors and people bought it. But now Sky is AAA status because he turned around the company from junk status to super high rated status, and therefore became a good investment to get involved in. So Sky became a AAA investment. That's an example of the difference between, say, Apple or the US Treasury with a two-bit company that wants to raise money in the bond market. So to recap, the bond market is a fundamental pillar of financial markets. It's called the credit market, where companies and governments can raise money by issuing debt. In other words, they say, we want $1 million, 200 million, 500 million. We need that money to run the company. We're willing to pay interest on that money. Come and take and invest in this particular bond. Give us the money so we can run the company or we can run the country. And then in 10 years' time or 5 years' time or 20 years' time, when you bring that bond to redemption, then we'll give you the money back. Now, another type of bond on the market is called a convertible bond. And that convertible bond is a bond that can be converted into another asset class within the company that's issuing it. So, for example, you might have, let's say, BP, Shell, Boots, Northern NatWest Bank or EasyJet. They might issue a convertible bond where you can convert that bond into shares, and they attach coupons, little cut-off coupons to the bond, and then either you can convert those coupons into shares or you can convert the bond into another asset class under a loan agreement or into actual equity. So there's all different types of bonds. It's a big, broad area, and I'm trying to keep it as simple as possible. But the main thing you need to understand is, number one, the price of bonds. Number two, the yield. The yield floats up and down in relation to the price of the bonds. As the price moves up, then the yield goes down. As the price moves down, then the yield goes up. Because remember, it's a fixed return on a price. So that fixed return, it becomes a percentage of, that's returning a percentage of the actual core value of the bond itself. So that's basically a lesson, hopefully understandable, on bonds, corporate structure, and government bonds. A little bit more. I forgot to mention the names of the bonds around the globe. You've got US, which is US Treasuries or Yankee bonds. You've got UK bonds called gilts. You've got German bonds are called Bunds. Japanese bonds are called samurais. So they put a different name to all different types of bonds. So when you're buying a bond from any particular investment in a country or company, then you've got to look at what rating they are and how stable they are. For example, Italy's bonds are high risk because Italy could go bust any time. Therefore, they give a high yield and the high risk bonds. Okay, so that's more or less it. This is Mayor Walensky with Driving Markets, and hopefully that will be a good educational slot for anyone who's interested in learning about bonds. Have a good weekend.